So I think that's very interesting. And this argues for, here's your seasonality, basically ignored seasonality so far this year. Now we're getting a little bit of a pullback into this very difficult period historically, which is the end of September. The second half of September into October tends to be a difficult period. And then October is not amazing, but it starts to recover. So another thing is, look, if you overlay 85 to 2015, you can see the market had a great run into the dot-com boom, into the financial crisis, and then into now. 2015 to now overlaid looks like we're going pretty good, right? We have this to go. We're just getting going on this nice big ski slope here. But, do you want to be a little bit more balanced? So I think this here, you can see forward price earnings for the S&P for big cap is kind of near the peaks, right? So if you sort of go, well, these guys, generally speaking, we know where all the money's been made. These guys generally kind of laid that foundation for broader prosperity and success, and they're getting a little bit on the expensive side. And we know that they can't just build data centers forever, although they're going to build them. Like there's no tomorrow for the foreseeable future because look at Oracle demand. I mean, they're not going to be able to handle that demand, but it doesn't change the fact that the demand is off the charts. There's no slowdown, but they are going to price that in at some point, and that's probably why Nvidia is a reasonable PE, because it probably does go to 225, but they're not going to price that at 100 times earnings like they did Cisco in 1999. Probably they seem to be a bit more measured in how they're pricing these things. And at some point, this is going to slow down a little bit. But what isn't going to slow down is the inference stage.